Bloomberg Audio Studios. Podcasts, radio, news. This is Bloomberg Intelligence with Paul Sweeney.
The real outperformance has been the U.S. corporate high yield. These are two big-time blue-chip companies. One person's chaos is another person's animal spirits.
Breaking market headlines and corporate news from across the globe.
Our view is that the economy is slowing down.
There is the possibility of a death spiral.
Both quantum computing and AI are going to power the future.
People are just buying everything with tech.
Bloomberg Intelligence with Paul Sweeney on Bloomberg Radio, YouTube, and Bloomberg Originals.
I'm Paul Sweeney.
I'm Norah Mulinda, filling in on Bloomberg Intelligence.
On today's Bloomberg Intelligence show, we dig inside the big business stories impacting Wall Street and the global markets.
Each and every week, we provide in-depth research and data on some of the 2,000 companies and 130 industries our analysts cover worldwide.
Today, we'll look at why the plane maker Boeing reported a smaller than expected loss last quarter.
Plus, we'll discuss why the Dutch brewing company Heineken reported a decline in beer volume sales.
But first, we begin with news in the railroad industry.
This week, Union Pacific agreed to buy Norfolk Southern in a $72 billion cash and stock transaction. The merger would create the first and only U.S. transcontinental railroad.
For more on this and the future of the railroad industry, guest host Isabel Lee and I were joined by Lee Klaskow, Bloomberg Intelligence Senior Transport, Logistics, and Shipping Analyst. We first asked Lee to give us his outlook on how this mega deal can get done.
Yeah, I think the whole speculation before the deal was formally announced about a possible consolidation. And I think people are just trying to take maybe a breather right now because there are some execution risks, right? This deal is not going to close, if it does close, until early 2027. It needs regulatory approval, which is not an easy thing to do. There were certain rules that were created at the Surface Transportation Board to make it very difficult for large Class 1 rail mergers to happen. That was because at one time in the 80s and 90s, those sorts of deals resulted in terrible service. I think that the rails today are much more cognizant of service as it relates to integration. And I don't really think either company, once assuming a merger does happen, are going scorched earth in terms of what they're going to do to their networks. They mentioned on the call that they had earlier today that they're really not going to lay off any frontline workers. Most of the probably layoffs are going to happen, in the offices. So that would just mean that services would prevail. And one of the reasons why they are doing this, from an outsider looking in, it does make complete sense. Between the two of them, they interchange around 1 million carloads a day. And if they're just able to, if that carload is able to be on the same network, it's not only going to improve network fluidity, it'll actually lower the railroads, their costs. Let's hope they pass on some of that cost savings to their shippers. I think that's what shippers might be concerned about. And it'll provide probably a better service product that they can go out and compete against other modes, such as trucks. And that's also a good thing because from an environmental standpoint, railroads are less fuel efficient. Trucking kind of deals with turnover issues and trucker availability issues. Right now, that's not an issue, but at times it can be. And so it is definitely a very interesting deal. It will create the first transcontinental railroad. But they do have their work cut out for them to get that regulatory approval.
So the deal is worth $85 billion. How do they plan to make money back? What are the financial wins, so to speak, to justify that hefty price tag?
Yeah, they laid out $2.75 billion in synergies. About 1.75 of that 2.75 is going to be from revenue. So what they're saying is that we can probably get more volume onto the network because it all of a sudden becomes a much more compelling service offering. And then about $1 billion in cost savings. And some of that, again, you don't need 2 CEOs, you don't need 2 CFOs, you don't need 2 corporate headquarters. They mentioned they are going to have their headquarters in Omaha, where Union Pacific is located, and keep I think they worded a major presence in Atlanta, where Norfolk is currently. But obviously they're not going to need as much space as they once have. And then there's technology benefits, so you're only investing money in technology once, not twice, to get those productivity improvements. So I think those are the major aspects of it. And they mentioned that they could be EPS accretive after year two.
Lee, he mentioned a lot of regulatory agencies are going to weigh in here on this deal. I also think President Trump is likely to weigh in. Do we know anything about how he might view this deal or just consolidation in general? What's the view as to the Trump administration?
I mean, we don't. The language that management noted on the call is like they wouldn't have moved forward with this transaction if they felt that it was impossible to get regulatory approval. So whether that means they were talking to the administration, whether that means they were talking to the STB or the DOJ or everybody in between, that's kind of, if you read between the lines, is what they were saying. The fact that they're not going to lay off any union folks is probably a net positive for a President Donald Trump to say, this is okay with me. So there's a lot of unknowns still. And again, this is going to take a long time. So we have a deal. It has to get Surface Transportation Board approval, which won't happen at least for a year and a half.
Could this spark more railroad mergers in the U.S.? And if it goes through, what will shipping look like in 5 to 10 years? You said absolutely. Please elaborate.
Yeah. So the other railroads in the U.S. are Burlington Northern, which is owned by Berkshire Hathaway. They may make their own bid for Norfolk Southern or decide, we're just going to go after CSX. Because if they do not merge, then they're going to be at a competitive disadvantage. Why would you want to send your freight across two railroads when you can send it across one? So it just would make sense. And if there is regulatory appetite for this kind of a transaction, you could see a Berkshire Hathaway and CSX coming. And if their competitors were able to get a deal, there's no reason why you wouldn't get a deal done between the two. A lot of ifs and buts and candies and nuts, but we'll see what happens.
Our thanks to Lee Klaskow, Bloomberg Intelligence Senior Transport, Logistics, and Shipping Analyst.
We move next to news in the drug and pharmaceutical space.
This week, the Danish drug maker Novo Nordisk announced that insider Mazier Mike Doustar would need to take over as the company's CEO. This came after Novo cut its full-year outlook, stating it had seen a decline of its blockbuster weight loss drug Wegovy.
For more, guest host Isabel Lee and I were joined by Michael Shah, Bloomberg Intelligence Senior Pharmaceutical and Biotech Analyst. We first asked Michael to break down Novo's recent guidance.
Reported guidance now is calling for 7% sales growth, 6% operating profit growth after adjusting for currency, and that compares to 14 and 15% respectively previously. Now, a lot of that is related to the US market. They're still seeing headwinds from compound and GLP-1, which seems to be the main driver that's affecting Wegovy growth. And there's a lack of visibility here. So all of that creates uncertainty for investors and also kind of questions around not only 2025 numbers, but the exit rate into 26. So there's concerns about, mid to long-term growth, given how concentrated or how reliant, Novo is on Wegovy for growth. The other headwind is competition to Ozempic. So that's the GLP-1 for diabetes, and that's another, key growth driver for the company. Second piece of news, new CEO appointment. So they went with an internal candidate. I think the market was perhaps expecting them to go for an external candidate. So, perhaps a bit of disappointment there. But that said, he's been at the company. So this is Mike Doustar. He's been at the company since '92. He's been heading up international operations since 2016. And over that time, we've seen international operations sales double to around $18 billion. So, he's an internal hire. He's familiar with the company culture. I think it's a bit too early to write him off before he's even started. Now, his focus is going to be on regaining ground to Lilly in the obesity space, maintaining leadership in the diabetes space, and then improving execution. And that's something that's going to be key ahead of the CagriSema launch, as well as the launch for its oral GLP-1 in obesity, particularly given, CagriSema perhaps isn't as differentiated as we had hoped for, and then the oral GLP-1 profile perhaps trails that of Lilly's.
The new CEO said he's planning to review the company's cost base without setting specific targets and metrics. So could this indicate that Novo is preparing for a period of slower growth after the initial surge in demand of especially the blockbuster Wegovy drug?
I mean, I think it'll be hard to slash R&D, to be honest. So I mean, and they would need to, continue marketing, continue to do DTC, in order to, in order to compete with Lilly. They're obviously heavily investing into CapEx at the moment, but there is probably some operating leverage in there, to provide some sort of relief. I mean, the company's got a margin of about 45%, which is at the top end for large pharma.
Hey, Mike, is there any reason to believe that maybe the marketplace has been overestimating the size of this obesity drug market?
I think there's always a risk with an indication this size. When you look at the market potential, in the US alone, it's 140 million patients, which is the target population.
I think that's one-third of our population, man.
Yeah, I mean, there is a risk that, perhaps consensus did get ahead of itself. But the difficulty here is, you have, huge runway of patients. There's obviously limited supply. So it's difficult to know kind of, how quickly that supply can come on board. Now, Novo gives guidance around, their growth prospects, where they think sales, et cetera, are going to go, but they keep, they don't necessarily quantify, the cadence of supply and how quickly that's going to come online. So that kind of makes forecasting quite difficult. And obviously they don't want to give that information because it's competitive information, and they don't want, Lilly to know about it either.
Our thanks to Michael Shah, Bloomberg Intelligence Senior Pharma-Biotech Analyst. Coming up, we'll discuss the importance of Samsung producing AI chips for the EV giant Tesla.
You're listening to Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies and 130 industries.
You can access Bloomberg Intelligence via BI Go on the terminal. I'm Norah Mulinda.
And I'm Paul Sweeney, and this is Bloomberg.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
I'm Paul Sweeney.
And I'm Norah Mulinda, filling in on Bloomberg Intelligence. We move on to earnings in the aerospace and airline industries.
This week, plane maker Boeing reported a smaller than expected loss for the second quarter, along with revenue that beat analyst expectations. Boeing also said it almost halted its cash burn last quarter.
Separately, JetBlue Airways posted a smaller than expected loss in the second quarter as demand rebounded.
For more, guest host Isabel Lee and I were joined by George Ferguson, Bloomberg Intelligence Senior Aerospace, Defense, and Airlines Analyst. We first asked George for his key takeaways on Boeing's earnings.
The free cash flow is still a little bit negative, not much. Cash from operations positive, a little bit, 200 million I think it was roughly on 200 negative at free cash flow, 200 positive in cash flow I think roughly. So we're seeing an inflection point here in cash flow. So cash flow had been negative for the last, I think it was 6 quarters before this. And I think that's just a sign of they're getting more aircraft delivered. They're going to, they've got a lot of inventory still. They'll pull off the shelf to build aircraft going forward too, pull a bigger proportion of stuff off the shelf than they would during normal times, which should juice that cash flow up, pretty well. So I think it's the turnaround is still is underway. It looks like it's well in in swing in the results we saw and the way company management commented on the end of the year, and so I think it was a pretty good results quarter for Boeing. Again, turnaround intact.
How are they addressing quality and safety issues, especially when it comes to the 737 MAX program?
Yeah, I mean, it's, as Kelly Ortberg said, it's a process. I think just the sign of seeing increased deliveries is showing us that the quality improvement at Spirit, has seen success. And they're talking about, they're at 38 737s a month now. Kelly Ortberg says he's going to approach the FAA in a short period of time and work on the 42 737s a month. So again, he must have some level of confidence that his quality and his engineering is good in order to go further. It's not perfect. They've been slowed down a little bit in the certification of 737-10 and -7. They've pushed them into 2026. I think it's okay. It's not a big move. We'd like to see them come faster because 737-10 is a large competitor to the Airbus A320, which is very successful, and one of the reasons they saw United place a big order with Airbus. But again, I think that you can't expect this stuff to go in a straight line, and the fact that they think 2026 is when they could get certification, it doesn't tell me anything's broke. It just tells me the process is nonlinear, and I think to be expected in aerospace.
All right. Also, JetBlue posted a smaller than expected loss here. What's going on with JetBlue and the airline business these days? Because I know the last quarter, boy, these airline companies are really reticent to give any kind of guidance.
Yeah, I mean, a lot of them have come back with guidance, in a lot of cases lower. The airline business right now is really counting on less capacity in the second half of 2025. And we'll see how that goes. Last time I looked at domestic capacity plans for 3Q, it's kind of about zero growth. I mean, I think they need to cut capacity in the marketplace. If you look at JetBlue's results, load factor fell by, I think it was around 300 basis points, down into the low 80s from mid 80s. And they held fares pretty much flat. Yields were kind of just up a little bit. So that just tells me that there's too much capacity in this market. They just can't fill airplanes at the right price. JetBlue has other problems like, the geared turbofan keeps them from expanding. That means costs are ballooning on them, but I don't see how they'd want to expand right now. What I see is a market that can't fill airplanes at the price that's going to keep them very profitable. And so someone's got to cut. And the question is who? The full service carriers are saying, hey, we got premium to subsidize us. We don't care. The low costs are going to have to. JetBlue will cut in 3Q, but every time they cut, their costs go higher per seat. So they're in a bit of a challenging position.
It does seem like the issues just compound for the companies in this space, from aircraft shortages, delivery delays, pilot shortages, wage inflation, labor negotiation, and so on. Are there differences in how Boeing and JetBlue addressing the issues, or is it really an industry-wide consensus and problem?
Well, I mean, if you talk to Boeing, everybody wants an airplane, right? And they're sold out on the 737 and 787 to the end of the decade. Everybody wants the newest. And I think what needs to happen is, again, the airlines are just putting too much capacity in the marketplace, especially in the U.S., and someone has to cry uncle and say, hey, we can't take the profitability at these levels. Park some airplanes, get them out of the business so they can right-size capacity. And I think nobody wants to do it. You have some competitors that are in a situation where some of them have already declared Chapter 11, it's like Spirit, and then refashioned themselves and got back out in the marketplace. But it's either someone's going to have to go away, or the market's going to have to get negative enough in profitability that people start to park airplanes. As we get into late end of this year, 4Q and 1Q, those are weak quarters for the U.S. airline industry. If something doesn't improve, if you've got a JetBlue that's barely positive in profitability in 2Q, without a change in this market, that's a strong negative. Near the end of the year, people will start to cut capacity and try to boost fares.
So, George, who does that? Is it one of the big three? I mean, JetBlue can't drive capacity in this industry. It's got to be one of the big three, right?
Yeah. Look, I don't think it's the big three are in a game of chicken with the low cost, right? Okay. They think that they've got pole position here and that they just keep capacity, and someone's going to fail on the low cost side because the low cost doesn't have this premium seating. They might be right. All right. Right now, it looks like their profitability is hanging in there. The low-cost carriers are the ones taking it on the chin.
Our thanks to George Ferguson, Bloomberg Intelligence senior aerospace, defense, and airlines analyst.
We move to news from the EV giant Tesla.
This week, we heard Samsung will make AI chips for Tesla in a $16.5 billion multi-year deal. That's according to Tesla CEO Elon Musk. Musk made the statement on X, where he stated that the strategic importance of this deal is hard to overstate.
For more guest hosts, John Tucker and I were joined by Craig Trudell, Bloomberg Global Autos Editor. We first asked Craig what this deal between Tesla and Samsung will do for the car maker.
Samsung is an existing supplier of these high-powered semiconductors that are used for its driving systems that it markets as full self-driving and autopilot. And contrary to those names, that you cannot buy a Tesla today and have it drive itself for you. You still need to pay attention and keep your hands on the wheel and eyes on the road. But it is the case that those systems are becoming more capable, and that Tesla's trying to kind of press the issue with them to the point where they're taking people out of the driver's seat and having supervisors in the passenger seat of cars in Austin, Texas, and trying to take that elsewhere as well. This will be interestingly, Musk announced that they will be going to a TSMC chip for the next generation of semis that they use, and then go to Samsung, relying on supply from this plant in Texas that Samsung is poised to open in the near future.
And when near future, how long does it take to build a fab plant? The cool kids say fab,
That's
right?
what they do. Yep.
Okay.
Yeah, that's right. Yeah, I mean, I think this is a project on Samsung's part that's been in the works for some time, right? And so they were sort of moved actually by the CHIPS Act under the Biden administration, and Trump was critical of the CHIPS Act on the campaign trail, and yet we've seen sort of a continuation and somewhat of an embrace of it as we've seen a change in the White House. In terms of the exact timing of when exactly this new AI chip will be coming out of that Texas factory, it's not yet clear, and the companies have not said much because they of course agreed to some privacy here that Musk proceeded to sort of loosen up on
Right.
at least over social media.
Craig, do we know at this stage to what extent Elon Musk is engaged in the day-to-day, the strategic of Tesla now that he's stepped back from his Doge responsibilities?
I mean, I think you can glean so much from his activity on X as to what he's paying attention to, and it absolutely is the case that we're seeing him posting more about things like this deal with Samsung, and I do think that that's helpful sort of for sentiment around Tesla. And yet, I would say too that if there was a sort of scorecard or sort of an informal scorecard that you'd be keeping track of where he's sort of devoting most of his time and attention to, I would say it's as much or more on XAI and just AI in general than it is on Tesla specifically. You heard from him a few months ago that he would really be turning his attention back to Tesla, as he was making his way out of the White House. But I think, the amount of attention and emphasis he's put on trying to catch up to the likes of OpenAI and Google in artificial intelligence and LLMs is, definitely exceeds, the amount of noise we're hearing from him about the day-to-day inner workings of Tesla.
Our thanks to Craig Trudell, Bloomberg Global Autos Editor. Coming up, we'll discuss the impact of President Donald Trump's big, beautiful bill on green hydrogen.
You're listening to Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies and 130 industries.
You can access Bloomberg Intelligence via BI Go on the terminal. I'm Norah Mulinda.
And I'm Paul Sweeney, and this is Bloomberg.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
I'm Paul Sweeney.
And I'm Norah Mulinda, filling in on Bloomberg Intelligence.
We move next to the consumer goods industry.
This week, the Dutch brewing company Heineken reported a decline in beer volume sales during the second quarter. This came as Heineken faced disputes over price increases with regional buying groups in Western Europe.
For more, guest host John Tucker and I were joined by Duncan Fox, Bloomberg Intelligence Senior Consumer Products Analyst. We first asked Duncan for his take on Heineken's most recent guidance.
Essentially, European retailers decided not or delayed pushing the prices up after, I suppose last year wasn't particularly big on pricing. It was about 3% of the global Heineken brand, but the previous 2 years when inflation was raging, they did get 14 and 10% respectively in 22 and 23. Costs of goods are not really going up, so I think the retailers just pushed back, and it took them longer to push to get a small price through in Europe, and that's just hit the sales. It's about 50% of the overall business.
What does a Heineken cost in the pub?
Well, if you're in London, a heck of a lot. It's probably sort of £8 plus. It can be above £10.
Wow. I should put a
which where I live in Dorset, you'd be lucky to get it. It's sort of around £5 to £6. But nevertheless, when you're pushing the price up, the premium Heineken brand, which is probably 20% more expensive than any other sort of mainstream beer that they've got on their portfolio, you can see why the volumes have struggled in the short term given cost of living crisis. So it's something they will resolve. They have resolved, in fact, on the pricing. So one would hope it will get better as we go through the second half with better weather that we've had in Europe.
So we had, I guess, the announcement of a trade deal between the U.S. and the EU. I don't think, what's it mean for the spirits business, the beer business, the wine business, asking for a friend?
I hope you've already stocked up, but 15% is probably a good outcome given some of the rumours that were going around from April onwards that it could have gone up to 200%. But obviously, the cost of beer coming in for someone like Heineken, they basically ship in from either Holland or Mexico. Some of the Mexican beer may well be tariff-free on the USMCA agreement, but then you've got the cans. So Lord knows how much that will push the price up. But yeah, they'll just have to push prices up on beer and spirits. Spirits at 15% probably say is not huge, but it'll mean pushing prices up 3-4%, something of that order, on top of what they would normally try and get. So it's not going to be easy to do, but it's not as disastrous as 30% or something like that, which Remy said would take profits down by 35 million euros. So a little bit better than expected or feared, but it's still not going to be great news. Wine, there really isn't anybody that exports wine that's quoted. So it's a bit difficult to say what the impact is, but it'll certainly make it more expensive compared to your good US grape varieties that come on the market. So I would have thought you'll see people switch to US wines.
I find this kind of disturbing, this part of the story where you quote the CEO of Heineken. Beer markets have declined at a pace Heineken has rarely seen any time before. Is this the end of humanity as we know it?
Well, if it carries on, I think there's been stories that the Gen Zs have given up on drink. I think that's wildly wrong. But there's certainly people are abstaining during the week a little bit. But the real problem is that people are drinking more at home rather than going to the pub. And that's sort of changed. That's the big change from COVID. So you've got to make sure you get your pricing at retailers right. It goes back to your original question. Because people are now, it's sort of more like 80% drinking at home in the US. It's anywhere between sort of 50 and 20%. Depends on where you are in the world, but a lot more people drinking at home than going to pubs and clubs. So the mix is poor, really, or has been, and it needs good summer would help, and it needs people to have a bit more money in their pocket as well. So maybe feeling a little bit more confident that they can go out and spend it with their friends rather than buying it cheaper from retailers and entertaining at home.
Duncan, I wonder if this is a national phenomenon, because it's a phenomenon on the Jersey Shore, which is people are drinking like these iced tea vodka things, the White Claws, all this stuff that's not beer. Are you seeing that? Is that a trend around the world?
Unfortunately, it seems to be that is a trend. You get a lot of ready-to-drinks being pushed, and they're big for sort of 12, 18 months, and it does tend to go against the beer volume more than anything else. Spirit companies are doing it with no alcohol spirits now, and they're also pushing you can buy gin and tonic or ready to drink gin and tonic and stuff like that. So there's just a lot more choice for the consumer than there was, when I was a kid. So yeah, it just takes a little bit of the shine off. You can try new things, I would say people are spending more or spending a similar amount on alcohol, they're just buying less of it in terms of volume. So it's all about getting the value right. Premium brands are doing well. Heineken premium brand did very well in these results, but it's only 24% of their overall volume. So, 4.5% on 24% doesn't sort of help.
Our thanks to Duncan Fox, Bloomberg Intelligence Senior Consumer Products Analyst.
Each week, we look at research from Bloomberg NEF, previously known as New Energy Finance.
They're the team at Bloomberg that tracks and analyzes the energy transition from commodities to power, transport, industries, buildings, and agriculture sectors. This week, we looked at the impact of President Donald Trump's big, beautiful bill on U.S. clean energy spending and on hydrogen.
For more, guest host John Tucker and I were joined by Martin Tengler, Bloomberg NEF's head of hydrogen research. We first asked Martin how the Trump administration is impacting the hydrogen sector.
Hydrogen was being portrayed, as you've kind of implied, as this huge economic opportunity until recently. And if you've been following the news, then you may have noticed that there has been a lot less news on hydrogen these days, with a couple exceptions. And I think this was to be expected. The industry right now is what we have called at BNEF, and what Gartner, of course, has called in their hype cycle theorem, a trough of disillusionment. So previously, people were too excited. We had this inflated expectation about how much hydrogen we were going to use, and we were going to use it in cars, we were going to use it in heating, we were going to use it everywhere. And at BNEF, at Bloomberg NEF, we were saying, no, that's not going to happen. Let's take a step back. And now we're kind of there. So we're seeing projects canceled and FIDs, final investment decisions, turning out not to be final and being taken back. So what's the problem? I would say problem number one is low demand. So a lot of producers, a lot of companies want to make this stuff, but not so many want to buy it. Why do they not want to buy it? Because it's turned out to be more expensive, especially the green kind, the hydrogen made from water with renewable electricity. And why is that? Why is it expensive? Because there's less insufficient policy than people expected, which kind of brings us now to Trump. So you're asking what's going on with Trump, what's going on in the US. So, of course, the OBBB, I hope I got the right number of Bs. And One Big Beautiful Bill Act got passed just recently, and that had lots of impact on, of course, clean energy and hydrogen as well. In one sentence, I would say it cemented the dominance of blue hydrogen over green. Of course, gray hydrogen, the one that we make from fossil fuels without any carbon capture and storage, we don't care how much we release. That's the one we make most of today.
Blue hydrogen?
Yeah, so blue hydrogen is hydrogen that's made the same way as gray from fossil fuels, which is made from natural gas, but where we try to capture some of the CO2 that's released in the process. And as you may be aware, the Trump administration, they like the CO2 or CO2 capture. So they've improved some of the conditions for the 45Q tax credit. Many of the tax credits got canceled or revised, but the 45Q for carbon capture and storage actually got better for blue hydrogen producers, who now can make more money if they do the enhanced oil recovery. So if they pump the CO2 back into an oil field and extract it, they now get the same amount of money as if they were just to bury that underground. So that's an improvement for blue hydrogen that's come out of the OBBBA.
So the tax credits favor hydrogen that's kind of polluting and not the stuff that's the good stuff? Or the less polluting?
I think no, that I would not go that far. So there's another kind of hydrogen which is green, which I also want to talk about, which is made from renewables. And the tax credits, there were very generous tax credits for that called 45V, and those got scaled down very significantly. So you now must start construction by the end of 2027, as opposed to end of 2032. In order to be eligible for this very generous tax credit that was passed by the Biden administration in 2022. So that's been a reduction in support for the green kind, which is lower emissions, and improvement for the support, very, very limited improvement, but some improvement in the support for blue. And then blue, there's a lot of questions around how much of the carbon you actually capture, but you could argue that you could capture 95%, as much as 95% in some situations. Has not been done yet, but could be done. And then actually it's not so unclean. So there's lots of people, some say it's very dirty, but others say it can be quite clean.
Martin, to the extent that this administration is not as supportive of the energy transition that, let us say, as maybe some other administrations, what does that mean for the global trends here? How important is the U.S. in terms of this global transition to, alternative energy sources?
Well, I don't think I have the expertise to talk about more broad alternative energy sources more broadly, but certainly in terms of hydrogen, again, which is my field, I would argue the U.S. is very important. People, when the tax credits were announced back in 2022, everybody was really, really afraid that the U.S. would jump in and take over everything in hydrogen. And then people were waiting and waiting for the final guidance on these credits, which came very, very late. And the US actually did not become a leader. But it can still be a leader on exports of especially that blue hydrogen that I talked about. The Japanese, the Koreans, they're keen to import some of it to burn in power plants, which we have a whole series of reports that says, bad idea. But if the Japanese and the Koreans want to do it, then I think the US is there and ready to sell that. And that actually happened. So we had a deal between, for example, CF Industries and a couple of Japanese companies to sell that blue ammonia, which is a chemical made out of hydrogen, to be burned in Japanese power plants or used in steel plants in Japan. And then you've got Europe, which is very, very focused on green hydrogen. They really want to adopt green as opposed to blue to reduce dependence on fossil fuels. But we still see an opportunity for blue hydrogen from the US being exported to Europe if the carbon prices here in Europe rise to the levels that we expect them to rise to in 2030 at BNEF.
Our thanks to Martin Tengler, BNEF's head of hydrogen research.
This is the Bloomberg Intelligence Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 10 a.m. to noon Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.